Welcome back to Today in Tax Court. And if you're watching this on my YouTube channel, you're gonna see this on the Plug newsletter. So if you're watching either one, go follow each other. Today's lesson, today's court case that I'm reviewing is Deutsch versus Commissioner, Deutsch versus the IRS, and it's extremely relevant today because it deals with losses. How you report investment losses, theft losses, or just general personal property losses. So it's relevant today because things are declining in value, inflation's happening, people are losing money, stock market's at an all-time high, people get greedy, you invest in the wrong things, they prey on that greed. And so there's a lot of different reasons how and why people will get defrauded or even just have investments go bad. And today's tax court case is actually about something that happened, I don't know, 10, 15 years ago, but it's very relevant because it has some really good lessons for us. So if you're following along, you can find this in today's, by the time this gets posted, it'll be yesterday's or the day before, but you can search it up. It's Deutsch, Aladar Deutsch versus Commissioner. And I'm not going to walk you, it's a 25-page court case, which isn't extremely long, but I would say 15, 20 pages of it are really just telling the story, which is, after a while, I felt like I was watching or reading an Ocean's 11 book. If you're watching on my YouTube channel, you'll see that I'm sharing the actual court case up here, and so I'll kind of scroll along as you see it. You can kind of see what I'm seeing and kind of looking at. Before I do that, real quick reintroduction. If you follow along, if you don't know me, if this is your first time watching or listening, my name is Roger Ledbetter. I'm a CPA in Texas. I manage a firm, a small CPA firm based out of Houston. We have people kind of all over. And so this is I talk about this stuff because it's relevant for me. Primarily, we work with pass-through business owners, partnerships, S-corps, the ultimate owners, the 1040s as well. And these things come up, right? Weird transactions happen during the year in economic busts and booms, right? And so I've been through enough cycles to where you see these things do happen, and so it's relevant. And I don't just talk about today's court cases. I've talked about historical court cases. If you scroll down in the history or of the feed, you'll see that I also talk about in Today in Tax Court history, tax history. I am a terrible nerd, and I'll just nerd out and go completely into a subject or topic that I'm interested in. And so I have like a couple 1-hour episodes to where, at least on the podcast, to where I've done that. We've talked about evolution of taxes in the United States, tariffs versus income taxes, and how we even got here. And so we'll do that, and then this is kind of the normal shtick, which is talking about today's court case. So let's get into that now. So quick background again. We're not going to read it all. This is primarily how taxpayer Deutsch. And I apologize if you speak German and I'm murdering that. That's how I'm going to pronounce it. This is how Deutsch kind of lost his money. So Deutsch had friends, and Deutsch had some money. I'll kind of scroll down because it does give you a good little background. So you can see here he was self-employed, right? Just reading along here in jewelry, and he made some money, right? He made a little bit of money, and then he started running with people who had money. And so what happens is you see this is primarily between Deutsch and Mr. Weisel or Mr. Wissel. And so what slowly happened as Deutsch and Wissel become more acquainted, Wissel started, I guess shilling is the right word, telling or advising or asking money for investments from Mr. Deutsch. And so there were a couple different investments that Deutsch invested in via Wissel, so you can see that here. And on those initial investments, he made no money. They were capital losses. Nothing happened. And so you can see the long-term capital losses on those returns here. But to Wissel and Deutsch's eternal optimism, there was a big deal on the horizon that Mr. Wissel brought to Deutsch, the taxpayer. And this was all around a $70 million transaction or $70 million deal backed by the Dubai Group. And you never, reading the court case, you never really understand what it was going to be about, if that $70 million was going to be a return on investment to Deutsch. Because what was happening here was Wiesel would tell him, I need $200,000 to open the account in London so the people in the Dubai Group can send me money. And so, he would send in these kind of $200,000 amounts, $300,000 amounts, living expenses, which we'll see, and it just kind of carries on, right? And so as it goes on and goes on and goes on, it's a little tough to keep. You're like, okay, well, who meets who? New characters get introduced, and from the Dubai Group. And then, this goes on for it was like 3 years, 4 years, where he's like, at some point he's got like $2 million invested in this venture, this kind of shot in the dark. And he's dealing with people using like a Gmail account. So he's got all this money tied up. And so here's kind of how the funding happens. Like in 2008, chasing this $70 million Dubai scheme, we see it's $175,000 that goes out to kind of set up the bank account. $200,000 in October. Later in October, another $200,000. Later in December 2009, we have $350,000. And so these are the four kind of primary wires that he had sent out on chasing this $70 million investment. And so that totaled $925,000. And it was so shady. It was set up. Wiesel would tell him, we have to set up a London bank account. These guys were based in Texas, where they met and kind of had started. And they say, we've got to set this and fund this account in London or a Swiss account, and you have to transfer this money back and forth to get it set up so there's enough balance in there so that they can accept the $70 million that we wired in. It was just, as you're reading it, and maybe it's just kind of armchair quarterback, but as you're reading it, you're just like, what is going on? Why are you continuing to send them all this money, almost $1 million, just chasing this investment over this amount of time? And so no real formal documents were ever really executed or signed. And so anyway, so Wiesel kind of has to keep up, and it's really, we get no definitive answer whether or not Wiesel, and we'll talk about that, was in on it, but what was happening? Where is all the support, the proof? Who did you meet? Why is this guy why are you sending all this money? But it's really, again, it's back to, he was a trusted friend, although he had never made a dollar together for him. And so while Wiesel's kind of explanation for the delay was that I'm taking ownership of the delay. I'm trying to go set up and execute docs and get it finalized so we can get the funding. But that's going to take me time. And so over 19 months, Wiesel convinces the taxpayer, Deutsch, to fund his lifestyle. And so over this 19 months, Deutsch wires him directly $295,000 for living expenses, for hotels, airfare, food, because he needed this money to chase, or he needed this reimbursement to go chase down this investment. So finally, after this, 2 years since it had started, I guess, Deutsch kind of, the jig is up. And so he hires attorneys and professional investigators, fraud investigators, to go look at this transaction, to go look at the groups behind it, underlying it. And so that's 2010. So that he hires these investigators, they start digging, and they kind of indicate and conclude that this was indeed fraud. Interestingly, or not, maybe, at the start of the relationship between Deutsch and Wiesel would take Deutsch down to a ranch in Mexico, or a couple of his family ranches, or his own ranches in Mexico. And what he promised was, if you will loan this money to start the investment, I will pledge my ranches to you in return. Well, as it kind of starts to unfold, you learn that the reader learns that the ranches were never in Wiesel's name. They were never Vassell's ranches. He had already transferred them to, I believe it's his son, to own. And so it was kind of non-there. And later on, Vassell and Deutsch kind of have a final, conclusion that he's not going to get anything out of Vassell. Vassell says, get out of here. I think Vassell ends up living in Costa Rica last time we hear about him. But it kind of, so by 2010, we see now that Deutsch is now left with $1 million plus between the $925 of capital investing it or chasing this $70 million deal and the $295,000 of living expenses. And so Deutsch wants to know, what does he do? What is he supposed to do with this loss? And so what he does is on his 2010 1040, after this investigation is kind of concluded that it's probably gone, he takes it as a loss. He takes it as a theft loss. And this is interesting because losses have to follow certain rules to know exactly what bucket they're in. And so if you see kind of behind me, this is like 3 years old by now. But in here is a walkthrough of taxpayer, not only income and transactions, but also deductions. And so one of these little arrows, it's like an arrow chart, is how you deduct losses. What losses are deductible? And so, what I wanted to cover on today, especially, was thinking through and talking through how he can take this loss. And so there's a couple of different types of losses I want to talk about. I'm going to scroll through this because we're going to get to the opinion. And it's a lot of, like this is all the background of it, like the back and forth and back and forth. It's page 12 before you get to the opinion. And there's a couple of different things that I want to talk about. And so what I think about when we're dealing with investment losses are, I remember when the Bernie Madoff Ponzi scheme came out. And what the IRS came through and said was the Ponzi scheme was actually a theft loss. And I don't know, the years kind of get fuzzy, but shortly thereafter, I guess, there was the Theranos loss, which I forget the lady's name. She's on X or Twitter, but I think she's still in jail. And so, she had committed investment fraud, lying about, returns and technology. And so people who invested in her business lost their value. And then I think through like another example of losses where like in 2017, Houston had Harvey, and nearly all of my clients had personal losses. And that's a deduction. And so where these all kind of combine is we have to think about how is the loss deductible? Is the loss even deductible? Meaning, can you exclude it or take a deduction against your taxable income for it? And if it is, what is it? Like, what kind of deduction is it? And the two types of deductions, if you can take it, are like a capital loss for an investment, or an ordinary loss. This is like a theft loss, which is what we're going to talk about. And so the rules, the current rules as is, are personal losses with a caveat, personal property losses that are not lost because of a federally declared disaster are not deductible. So think about if you're walking down the street and you have a nice watch on and someone steals your watch from you, you get mugged, someone steals your wallet. Sorry, you lost the money. Money's gone, you lost the value, you don't get a deduction for that. Sucks, file a police report, go after it. Losses where you lost personal property in a federally declared disaster area, on the other hand, are eligible for ordinary losses. And there's some income limits and like $1 deduction you now have to do to kind of limit or cap that, the floor. But like if you had a nice watch, I don't know what a Rolex costs, $10,000 Rolex, and you lose it in the Harvey floods, you can take a deduction on that as long as it's logged and you got to, whatever, log it, make sure you have the support and proof for it. But that, because it's a federally declared disaster loss, you get an ordinary deduction for that. And it ends up flowing through 4684 and winds up on your Schedule A as an itemized deduction. And if it's not the personal property losses, it could be a capital loss. So think like stock goes down in value. And in the Theranos case, this is what happened. It wasn't deemed to be a Ponzi. It was deemed that she had just misrepresented the actual underlying facts of the company. Yes, it was bad. Yes, it was fraud, but it wasn't theft. And so I believe that was the result. It's been a couple of years on the Theranos case, but you end up taking a capital loss on that. And that's compared to the Madoff scheme. In Madoff, what was determined was that you were investing in an individual who said he was then investing in stocks. And he wasn't. It was gone. The money never made it to the stocks. He was printing fake reports and fake PDFs and issuing fake statements. But because of that, it was deemed a theft. Therefore, as it was a theft, we're back to the rules we talked about where you can deduct it. It is deductible as an ordinary loss. What was happening here and the rules that Deutsch was following was that this was actually a business for-profit motive theft. And so the rules are still, kind of even different, but they, meaning there are not, so a business for-profit theft loss is not subject to that same kind of like $100 deduction and then 10% threshold of AGI. That's really the only thing that makes it different. It'll still flow through, in the taxpayer's case, in Deutsch's case, it still flowed through his Schedule A as a deduction. And so what the court says is they kind of work through it systematically, and they say, what is a loss, right? We first have to determine. So kind of just cruising through, and I'm cruising through because I think this is interesting. This is kind of how I look at opinion, read an opinion. But the court will walk through like, are you entitled to it? What is theft? And so they'll pull up Texas law. And so it's interesting because this is kind of where states start to integrate, and where you live kind of integrates into federal tax purposes. And so what they do is the court pulls up, well, was this a theft? Legally a theft based on the state that the taxpayers lived in. And so taxpayers lived in Texas, so they pull up Texas. And so what they determined was that it was, and I'm looking for the actual language in here, but it was an intent to deprive the owner of the property. So it's an unlawful appropriation with the intent to deprive the owner of the property is what it ends up being. And it was determined that this now meets the definition of theft in the state of Texas. So check, this is theft, right? And it's a for-profit motive, right? So he had invested in this entity with the intention of making money, right? And so it's theft, for profit, right? And so yes, it's deductible. What the IRS kind of countered with was that it's not officially a theft because you can't prove who stole the money. They couldn't bring a Mr. Vassell and call him in because he was in Costa Rica, right? You couldn't, and even then, you couldn't even prove that Vassell was not himself defrauded, right? The question was, is Vassell guilty, right? Is Vassell guilty? Did Vassell know about this? Was it someone else in the Dubai group or representing the Dubai group who was the perpetrator of the fraud, and Vassell was just this innocent party? And so it became this question of, well, who the IRS challenged the deduction, say it's not really theft because you can't prove who stole from you. The court overrules that. There are a couple different cases that it references, and it says that you don't have to do that. You don't have to identify who it was. Rather, what's important is that it did happen. And so proving a theft happened is more important than proving who did it, right? You don't have to necessarily bring them to a criminal trial to evidence the theft, to evidence that it was theft against you. And so I thought that was a really important rule here. So it is theft. You don't necessarily need to know the actual identity of the person who stole it. Was it this guy? Was it the Dubai group? Was it someone else? And so who was actually guilty, you don't need, but you can certainly conclude that there was serious theft that was here. So the taxpayer, Deutsch, had deducted, when they reported this, the entire thing. So they said, my 925 and my 295. So remember the 925 was strictly from, and I'll kind of scroll through here. The 925 was strictly from the investments in it, so funding the bank account so you could get the money back. And then the 295 was the living expenses. And so the living expenses were actually determined to not be theft. And the court agreed with the IRS partially on that the 295, there was really no deception there. Deutsch paid those to Vassell based on Vassell's request to live. He knew who he was paying and what it was for, and so he didn't really lose that money. Now, yes, that should have been a loan. Yes, it should have been structured, but it was how he structured it was just advances to him, and so he wasn't necessarily deceived. And so the court says that 925 for the fraudulent transactions were legitimate theft loss, but the 295 was not. So another kind of wrinkle, I skimmed past it here, was what year it's deductible in, right? And so there's all these kind of angles. Again, is it theft? Is it a capital loss? Is it a for-profit theft loss? Do you need to know that person? The other one was, what year does it go into? And so if the amount is not determinable or final, or there is no more reasonable prospect of recovery, then you can take that loss as theft then. And so if there is a chance you could recover it, then you don't get the loss, right? You don't get the theft loss. You can't say that it's just maybe I'll get it, maybe I don't. You don't get to play games like that. It kind of has to be definitively unrecoverable. It's got to be the money's gone. Now you're at a big fat zero. And so what the court agreed that by 2010, Deutsch had made efforts to collect it and had clearly shown good faith in hiring the attorneys and the investigators. They concluded that the money was gone. It was clearly fraud. And so it was determined that 2010 was actually the right year, right? There's no way this money is ever going back to you. And so that's kind of where it ends. Interestingly, the IRS also ends up charging back gross misstatement interest, right? So there's this big penalty, this 20% accuracy penalty, because it was a substantial underpayment. And what the court ruled is that it's actually not. They didn't respect it because they relied on the CPA. So they had a CPA prepare their tax return for 2010. And so this is kind of one, it's not great. I don't always love falling on this sword, but it is out there that if you pay me for tax advice and I give you bad tax advice and you rely on that tax advice, you're actually not liable as the client for relying on that bad tax advice. If it was reasonable, you had reasonable ability to rely on it, I'm a competent professional, right? And if you do those things, you can avoid some of these penalties. So the court agreed that they did rely, they had reason to rely, and it was a competent CPA. And so the 295 that otherwise would have been subject to this additional penalty was not. And so we come with kind of this split decision. I'll kind of come down to the bottom. And so they come down and say, well, the 925 rather was deductible as a business theft loss, and then the 295 of personal living expenses was not. And so they end up owing a little bit of tax back, but the majority of it, the 925, did get sustained. And so, what are the lessons here? Pulling back a little bit, what do you take away from this? And I think it's a couple things. When you lose money, there's always a tax angle. And so understanding what the tax angle is really important to make sure that we don't compound mistakes. And I'm just thinking through as an aside on like if you lost money on a real estate investment and you're a passive investor and you invested this money, but the money's now gone, the equity's been wiped out. What year does that happen in, right? And how does it happen? And a lot of times when that does happen, there's phantom income and phantom gains, right? And so these are all things you have to consider when we're going to take losses on these deals. You're going to take losses on investments. And then the other angle is win. And so a lot of times if you have more control over it, we do things like capital loss harvesting. And so if you're going to have a big year with a big capital loss, you can harvest a lot of gains against those losses, right? So there's some capital gain, capital loss harvesting at play. When we deal with real estate, we look at suspended losses. How do those impact when equity's been wiped out? And so I'm just kind of thinking through other examples that I see when we have losses, when you sustain losses on investments. What do we look at? What are things that we need to consider, need to talk about that are going to impact your tax bill at the end of the year or your tax estimated payments in the following year? The other thing is then don't automatically assume that it is a theft. A theft is a relatively high bar. So a lot of times you just think, I got stolen from and this is a write-off, right? And so the theft really matters. And so you see this, a kind of corollary is like business bad debt. People would say, I'm going to take a business bad debt deduction on this loan I made. Well, there's a lot of thresholds that you start to talk about when you're taking these losses. And so in this case, they met the thresholds, they met the bars, they were legitimate losses, and he was entitled to ordinary deductions to offset his kind of current and ordinary income instead of capital losses or instead of being kind of disallowed altogether. So when you lose money like this, call a professional, call a CPA, reach out to us, talk through it, get all the facts and circumstances. It's not also just as easy just to kind of throw your hands up and say, well, that's a loss, especially when you're pushing for a theft loss or a loss that can be taken against ordinary income. That really matters. So paper it up, making sure you have instances and examples and proof that you were pursuing this investment return. I think that's really it. I think that's it was a good case. I haven't done one of these in a while, kind of jamming through a tax court case. Again, it's Deutsch versus Commissioner. It came out today, which is August 12th. By the time you read this, by the time I post it, maybe tomorrow. But read it. If nothing else, it's interesting backstory. Who all got defrauded, how they got defrauded. There was actually another friend that also got defrauded, but he ran out of money. And so what ends up being is that, Vassell gets most of the money, ends up getting most of the money from Deutsch. So it was a good court case. I hope you liked it. I hope you read it. We're going to keep doing these again. I'll get back on the wagon. For what it's worth, my kids found my YouTube channel and they said I need to smile more. So I'm doing my best to do that. And they said I need to lock in and do more videos. Here we are doing it. So follow along. If you're doing the podcast, leave the rating. That helps me. Let me know. Reach out to me. I'm on Twitter, rledbettercpa. I also have my newsletter, plug-newsletter.com or plug-newsletter.kit.com is a platform it's hosted on. If you get those, you can email me. I check that email inbox, me personally. I don't have anyone working on that. So feel free to reply or reach out to me there. And I hope you enjoyed it, and we'll keep on doing it.